Are the recent stock market bumps in the road going to lead to sinkholes? So stay tuned for the full segment to find out what's next. Welcome back. This is Richard with Wisdom Investor. In some of our recent videos, we've talked about saving enough money for retirement. Now, the other side of that is we need to get a good return on our money so that it will grow and compound. So we're going to look at the markets here, where the markets are headed in the next few months. Is this the time to buy, or is this the time to be cautious? So stay tuned for the full video. We're looking at the Dow Jones Industrials average here. We're looking at a weekly chart that goes back almost 2 years. You can see on the left-hand side the big dip we had in the markets for the pandemic, and since then the markets have been moving higher. Okay, we're going to zoom in on the Dow Jones Industrials. At the far right, up at the top right, you can see where we've had some selling in the Dow Jones Industrials. It's dipped down as low as 33,500. The first horizontal blue line is the 33,500 mark. Now, that should be a pretty good support area. If we start to go below 33,500, we could go down as much as 10%, which is going to take us down to around 32,000. If the market does get down there, I think the Fed will probably come in and try to stop the markets from going any lower. Now, worst case, we get a 20% decline down to 28,500. But I think for right now, that's very unlikely. So what is the biggest reason for some of the selling? It's primarily the Fed not juicing the markets as much as they've been. If we look at this chart here, this is the S&P 500. If you see the green line rising on the left side, that's basically showing you that the Fed is juicing the markets. And then you can see down below in the black, that's the S&P 500, and the market's going higher. You can see recently here where the green line has started to move down. The Fed has been taking some of the juice out of the markets. Therefore, we've had some selling to the downside. However, it hasn't been severe. So really, if the Fed is juicing the markets, it's going to continue going higher. If they take the pedal off the metal, the market may dip lower. We're going to take a look at the one-year seasonal pattern for the Dow Jones Industrials. Now, right now, we're closely approaching the October area. Typically, based on the seasonal past history of the Dow Jones Industrials, we typically get some type of a bottom around October sometime. Then the market starts to head higher. We're looking at the seasonal pattern here for the S&P 500. You can see here in September, typically that's the worst month of the year. And then October can also be a negative month, and then the market starts to move back higher in November and December. So based on some of the cycles that we have seen here, typically the markets bottom around October or November. We're looking at a chart put together by Larry Williams. He's been working with stock market cycles for over 60 years. And according to this chart here, on the bottom right, he's estimating a low in the market, or a buying opportunity, as he would call it, around October and November area. Now, that doesn't mean the market's going to crash to get this buying opportunity. It doesn't even mean that the market will go down. But based on these cycles, he's looking for a buying opportunity around late October. So far, the markets have been able to avoid any major dips lower. Each time the market dips, buyers continue to come in. As long as the Fed continues to juice the markets, I think the market's going to continue moving higher. If they take the pedal off the metal, we could see some dips in the market. As long as there's no sustained bad news, it's going to be hard for the markets to move lower. Also, interest rates are not expected to be raised until a year or two from now. So that is going to be positive for the markets. So the bottom line is here, we'll be watching these levels. So I want to thank you for watching. Stay tuned for our next update.